My research focuses mainly on the causes and the consequences of corporate tax policy choices. It's corporate boards that are in charge of hiring and firing CEOs, so the fact that we find some evidence that CEO departures are tied to the corporate tax policy outcomes suggests that CEOs are being held accountable. We found evidence consistent with our hypotheses that if you're a CEO at a firm that's paying too much tax relative to your peers, you're more likely to be fired. And the same thing if you're a CEO at a firm that's paying too little tax. What's interesting about our finding, there's been a maintained hypothesis in our literature that says CEOs might not be able to impact corporate tax outcomes because they're rarely tax experts, and it's unlikely for them to be involved in the day-to-day operations of tax policy. So what we hypothesize in the paper are that CEOs who pay too much tax or too little tax relative to their peers are more likely to be fired. If you're paying too little tax, you're bringing undue risk upon the firm. It could be that the IRS might want to collect some of those back taxes, assess some penalties. And there could also be some undue attention from the media and also from consumers. And if you're paying too much tax, then what that signals is some ineffective tax policy management. And what you're essentially doing is having a wealth transfer from the shareholders to the government. You're giving the government more than you're legally obligated to pay them. We were fortunate to get a unique data set from some other researchers. And what is interesting about that data is it looks at all CEO turnovers over about a 15-year period and separates out those turnovers that are most likely due to the CEO being fired by the board of directors from the CEOs that have left the firm because of natural retirement, because of health issues, or because they've passed away. I'm James Chyz. I'm an associate professor, Department of Accounting and Information Management.